everyone. Thank you for joining us. We appreciate your being here. I'm Sarah McGregor. I am one of the presenters for today's session where we're talking about year-end tax planning for businesses. This is an important time of the year for us to look at what companies can still do in the last 6 to 8 weeks of the year to improve their tax situation. I'm joined today by Rodney Myers. He's a tax senior and works out of our Tampa, Florida office. I work out of our Greenville, South Carolina office. Unfortunately, Rick Woods, who was going to join us, is not available today. He works out of our Louisville, Kentucky office and is part of the team from MCM CPAs that joined us just this year, which we're delighted to have. Any of you who were clients of MCM that are joining us on the presentation today, welcome. So with that, let us sort of get started and talk about where we're going and what we're going to highlight. When we got to thinking about the tax planning for this year, we looked around and said, you know what, there's probably about 10 things that we should highlight for businesses that affect most all businesses one way or the other. Section 174 is a big one. This is the requirement to capitalize and amortize research and experimentation costs that came into play first for 2022 and impacted a lot of taxpayers as they were finishing up and wrapping up their 2022 tax returns. The second area we want to talk about is the change in bonus depreciation that's happening now. Pass-through entity tax election and planning for that is still a big deal as we wrestle with the new states that have adopted PTE, as well as all the states that have made changes in their PTE election programs. Clean energy tax credits and incentives are now coming into play here that first became effective or were expanded and enhanced by the Inflation Reduction Act. Pass-through entity losses. This is the time to take action with respect to making sure that those losses can be deducted on the owner's returns. There are some compensation and benefit plan strategies that could still be implemented before the end of the year that can be beneficial to companies. Looking at buy-sell transactions, international activity and associations and companies and investments that may have happened this year that could change how the tax consequences. Then we're going to look at some traditional planning, scrubbing the balance sheet for deductions and other ways to defer income or accelerate deductions at the end of the year. As we go through this, of course, just want to make sure that you know these are high-level presentations of ideas. Everything needs to be looked at in terms of your own company's position, circumstances, and how the law and guidance affects your particular company and its situations. So with that, we'll get started. And let's first talk about what is new in 2023. What it takes is different this year than has been for the prior years. Well, 174, as I mentioned, first came into play in 2022. This was, as many of you know, was enacted with Tax Cuts and Jobs Act, but the actual implementation of that change to Section 174 did not happen until 2022. And everyone thought for sure that Congress would get around to delaying or repealing this provision that requires these costs, which had formerly been eligible to be expensed in the year incurred, now must be capitalized and amortized over 5 years for domestic research activities and 15 years for foreign research activities. And specified research and experimentation activities now includes development of any software, which is also causes a lot of concern for companies having to capitalize those costs in the research space, in the tech space, in the software development space. Well, finally, right at September 8th of 2023, we got some guidance from the IRS. Someone referred to this as the proposed regulations. So the IRS intends to issue proposed regulations consistent with the guidance that they issued in this notice 2023-63. The notice applies to tax years ending after September 8, when it came out, but taxpayers can rely on it as early as the 2022 tax year, 23 tax year, and going forward. And the IRS is also asking for feedbacks and comments on the guidance in this letter, and they've received a lot of guidance and a lot of comments so far from taxpayers. The notice is organized into these 9 sections. The most important sections for application comes in the middle part of this. Section 4 discusses how broadly and what's included as a specified research activity. Section 5 talks about what is and isn't included in software development. Section 6 talks about research performed under a contract where you're performing that research for someone else. We often refer to this as funded research. A company is getting funding to do research work for another company or for a government entity under a contract. And finally, there was some limited guidance given out on the disposition, retirement, or abandonment of property associated with these specified research expenditures, which have been capitalized. And actually, there's very little that can be done to accelerate the deduction of those capitalized costs. Pretty much they're going to be capitalized over the long term. And then finally, the last 2 sections try to clean up and provide some guidance where there might be a disconnect between when revenue is recognized and expenses incurred under long-term contracts or cost sharing regulations to smooth out those issues that might arise. So the key issues addressed in the notice, the first was beneficial. We thought maybe we were going to have to use something similar to Section 263A, Uniform Capitalization of Cost to Inventory, as the model for how to look at costs that were beyond direct costs associated with these activities, with research activities, and how far into the other supporting costs and indirect costs you have to look. And the nice part was the notice says, we're thinking that there should be a cost benefit relationship. If there was an indirect cost incurred, does it benefit those specified research activities, those SRE expenses? The second area was about funded research. This was less favorable. Section 41, the research and development tax credit, uses a both and. So if you have retained rights and financial risk, then you would be eligible for the tax credit. In this case, if you have either retained rights in the intellectual property or product that's produced or financial risk, you could lose money if the research doesn't turn out the way it's supposed to. Then either of those situations, then you are incurring costs that have to be capitalized and amortized. Some good news in the software development, well, mixed news, I should say, defining identifying activities that are included and not included in software development. And finally, that this is going to be an automatic accounting method change and will give us an easy way to adopt the accounting method for handling these related expenses. So more to come. There were more questions asked at the end of this, but we did get some direction and guidance from the IRS with this notice, which is helpful because we didn't have anything before. So Heather, this brings us to our first polling question. If you want to go ahead and pull that up. How much asset base can be deducted under bonus depreciation in 2023? Is it 100%? 80%, 60%, or you're just not sure how much can be depreciated in 2023? We'll let you go ahead and take a crack at answering this poll. And we'll give you just another little bit so that everybody has an opportunity to take this into account. For those that are looking for more information about the notice 2023-63 and about the section 174 costs, I encourage you to take a look at our firm website, cbh.com. Our tax credits and incentives team, our R&D credit team, have put together several webinars and several information articles and other resources about this. So I encourage you to take a look at those and to learn more about both of those areas. All right, I think we're finished with that poll and we can move on to what's next. So Rodney, tell us what the answer to this question is.
Thanks, Sarah. And the answer is 80%. So beginning with 2023, the accelerated bonus depreciation provisions of the code are going to start sunsetting by 20% each year until we get to 2026. The non-accelerated portion of those assets will be depreciated under the normal depreciation rules under makers. So that is the difference. You'll get your 80% acceleration, and then the remaining 20% will be depreciated based on the regular provisions, depending on the life of the asset. So just keeping in mind that from planning purposes, it's going to keep dropping. Looking forward into what we discussed or highlighted previously was pass-through entity elections. To quickly review, the pass-through entity election is a tax election to have the pass-through entity pay the tax. Pass-through entity pay the tax as an entity level tax. What that means is the benefit of the election is moving the state tax burden from the individual to the entity and making the taxes paid an above the line deduction for the business where it wouldn't be limited under the $10,000 SALT cap at the individual level. Some things to be considered are that the state pass-through entity tax payments should be made before year end. And then one of the other planning items to be considered are there any refunds from 2022, or are there any overpayments being applied to be considered? Now, when you're looking at pass-through entity tax election planning, note that there are various results between owners. One owner can benefit while another owner is disadvantaged. There could be conflicts of interest between owners. So when you're reviewing the situation, it should be reviewed to determine how beneficial it is to the members. Additionally, you may have to look at your partnership agreement. Do you have to make any changes to your partnership agreement? Can you make any changes to your partnership agreement at this time before you need to make the election? Lastly, as corporation shareholders need to monitor the distributions. You need to make sure that the distributions are still pro rata amongst the members so you don't violate your S election. Furthermore, there are differing rules on how the election is made. It varies state by state. And again, as we've talked about previously, the states are enacting this at a different rate. So it's not across the board amongst all states at this point. And then each state has decided to make the election in their own manner. Some states make an annual election. Some states make a one-time election. Additionally, is the election irrevocable? If you make the election today, is it something that you can change in the future? Did you already need to make the election? And then lastly, does the election apply to all owners? So when you're looking at the pass-through entity election, it's mostly useful where the most useful PT generates income in a state where owners are individually domiciled in the same state, or you're looking at individuals residing in states with no individual income tax. Now, Sarah will be speaking about updates to informational reporting and other items from the Inflation Reduction Act of 2022.
Right. So something new this year, we will see Forms 1099-K issued for the first time. In large measure, the threshold for reporting on Form 1099-K is reduced to $600 for all transactions with a particular service provider or payor. So who is issuing these Forms 1099-K? That is, the official term is payment card processors and third-party network transaction companies. Well, who are they? That means Venmo, PayPal, Verbo, Etsy, eBay, all of these online resources where you're transacting services, you're moving money back and forth. There are opportunities there and responsibilities for issuing these 1099-K. So we fully expect that, and the IRS expects that taxpayers will receive tax forms on 1099-K that are inapplicable. That was not a sale transaction. It was not a business revenue transaction. We were swapping money to split a bill for dinner. Or that was money I emailed or forwarded to someone else. It was not for the payment of services or otherwise. but the IRS has issued instructions on how those transactions can be flagged and subtracted out on an individual's 1040 return. They're still going to have to be reported. Can't just ignore them, but they're going to be there. But we're also expecting to see the similar 1099K issues popping up for partnership returns that receive Form 1099Ks. So just be on the watch out for that happening. And if you run your own business through a Schedule C, you're going to see more of these Forms 1099K. The Inflation Reduction Act introduced a number of new clean energy credits and expanded and enhanced some existing clean energy focused credits. These credits and deductions incentives are designed to help boost the production of clean energy and improve energy efficiency. A couple of the ones that we're seeing active for businesses, 45W is the qualified commercial clean vehicle. It's up to $7,500 for gross vehicle weight of 14,000 pounds or less, and up to $40,000 of credit for those vehicles that are heavier than that. So the more we see of trucks and other delivery vehicles and heavy equipment that's going to be plug-in or electric fuel cell or some sort of plug-in hybrid, they're going to be eligible for these credits that are coming. Another area is the Section 48 investment tax credit and the Section 45 various production tax credits. The investment tax credit is there for installing solar panels and wind turbines and geothermal equipment and combined heating and power systems. It's an investment tax credit based on the base credit is 6% of the cost of the equipment placed in service. We'll see in a moment how these credits can be increased. The Section 45 is a production credit. It is for the production of clean electric power and hydrogen fuels and other molecules that are helpful involved in clean energy production. The way the credits work and what we're seeing most of are those Section 45 production credits, and you can increase the credit 5 times from the base, so that 6% can go to 30% if the installation and preparation of that equipment meets prevailing wage and apprenticeship requirements of those that are working on the project. In addition, if the facility or the equipment meets a domestic content requirement, it can go up another 10% and another 10%. And another 10% and another 20%, depending on where that property is installed and located. So for an example, we've got ABC company that is invested in a solar project, setting up a solar panel arrays on its roof and a battery storage component. The project is expected to qualify for the investment tax credit under Section 45, the various sections under 45. And construction on it begins in 2023 and is placed in service in 2023. So when it is placed in service, ABC company is eligible for the tax credit, and they're going to meet prevailing wage and apprenticeship requirement, and that's going to get them to the 30% credit, 30% of costs incurred. And then they also happen to be in an energy community, that's where they're located, and so they're going to be eligible for an additional 10% bonus. So you can see where they can get up to a 40% credit here. And with the size of projects that are going on, the investments that are happening, and the amount of credit available, so you tell me with our next polling question, do you think C corporations will be interested in buying these clean energy tax credits in a marketplace that are starting to pop up? So do you think C corporations will be interested in buying these tax credits from companies that are installing and taking advantage of these clean energy facilities and generating these credits? Yes, no, or not sure. And we'll give you just another second here to work on that. All right. I think we're getting close. on that piece. Okay. The answer is yes. As a matter of fact, C corporations are taking advantage of that now. We've already seen a number of large companies with multi-million dollars of tax liabilities setting out to acquire these credits. And even though they've just got guidance on how to transfer those credits between taxpayers, came out this summer. We saw a great deal of projects getting in place here in before the end of the year, where companies are lining up to acquire and purchase those credits. They're not good for individuals, as good as successful for individuals and for small, closely held companies that are subject to the passive activity limitation rules, because these are designated currently as passive credits. So they can only be used to offset passive income, which makes them not very viable yet for at this stage for individuals to purchase. There is discussion about making these credits more accessible to individuals by removing that passive descriptor or identifier on these credits, and therefore they would be available to offset more income, but that is not the case at this point in time. So Rodney, let's move forward and talk about some real estate and pass-through entities and some planning for them.
Thank you, Sarah. So when looking in the real estate sector, there's a number of opportunities available for the deferral of gains on sales or exchange of properties. Some of the ones highlighted here specifically are the Section 1031 like-kind exchange. So a 1031 like-kind exchange offers the opportunity to defer the gain on real property from that perspective. Now, keep in mind that if you're going to entertain the Section 1031 like-kind exchange, there are certain steps involved in the process that must be completed in order to qualify for the tax deferral treatment. And a number of these items must be completed either during or prior to the sale. So please seek proper advisement from that perspective when you're looking at considering the Section 1031 like-kind exchange. Additionally, still out there is the Section 1400Z opportunity zone. The opportunity zone qualifications allow you to roll a gain into a qualified opportunity fund. Now, keep in mind, whereas 1031 exchanges were for only real property, the opportunity zone is available to any capital gains from that perspective. So any capital gain can be invested into the opportunity zone. That gain then would be deferred until the end of 2026. So you would still get about a 2-year deferral at this point, or two to 3 year deferral from that perspective. And then one of the big benefits of the qualified opportunity zone is that if you hold the investment for 10 years, you eliminate the tax on any future appreciation. So one thing to consider is that it's a long hold, but there are benefits to be realized from that perspective if you find a very tempting investment. Lastly, there's Section 1033 involuntary conversions. This is the situation where you maybe have a fire or condemnation or some other type of situation where you get insurance proceeds on a property, and then you have time to acquire qualifying replacement property within the time limits to defer the gain. Moving on to credits and incentives, there are a number of items available to the real estate sector with regards to credits and incentives. First, there's the Section 45L energy efficient home construction credit. So that is for eligible contractors for newly built energy efficient homes acquired for use as a personal residence. Those contractors can apply for the energy efficient home construction credit. One of the larger items that's come about from the Inflation Reduction Act is Section 179D, energy efficient commercial building deduction. The Section 179D deduction is available for commercial building owners and those that work on the construction of these buildings. It was expanded under the Inflation Reduction Act of 2022, and it now offers up to a maximum deduction of $5 per square foot for an eligible building. The key here is that you're making energy efficient improvements to the building from that perspective, and that's the key here. Lastly, in this one, the Inflation Reduction Act increased the deduction frequency associated with Section 179D. Originally, this was a one-time deduction for the commercial buildings, but however, commercial building owners can claim the 179D deduction now as often as every 3 years. Sarah did mention this earlier, but with these additional deductions available, there are additional reporting requirements for prevailing wage and apprenticeship programs. Again, as mentioned, our tax credits and incentives teams have put together a plethora of material on this and other webinars from that perspective that I would invite you to reach out, review those as well. Just to hit briefly, there's also historic rehabilitation tax credits and also low-income housing tax credits available. Moving on to cost recovery. This is something that's been out there for a while, but it's still something that's available to review and always a good planning strategy. When you buy a new building, from that perspective, you can perform a cost segregation study to look at accelerating depreciation on the short-lived assets in the real property. So what that means is that if you buy a building for $5 million and you're able to identify that 2 million of it is not the 39-year property, you'll be able to accelerate it either over a shorter life, or it could qualify for bonus depreciation or even the 179 expensing for eligible assets. Now, for 179, there are limits on the total investment, and then there's also a taxable income limitation. What that means is that you can only take 179 if you have taxable income, and then it does begin to phase out if you're placing too much property into service. So when you're looking to the end of the year and planning from that perspective, there's a combination to be considered between bonus depreciation and 179 now, with the sunsetting down to 80% and that going down even further in the future, and the implications of 179 depending on if you're a taxable income or not. Lastly, one of the other things to look at is the 163J election for real property trade or business. What that is trying to make the election to get out of being subject to the 163J limitation. Lastly, looking at claiming pass-through losses. There's now currently a gauntlet of approximately 4 hurdles that have to be overcome for pass-through owners in order to be able to claim pass-through losses. So, you hit the end of the year, you're looking at your losses, and you go and you're reviewing and saying, I have an ordinary, or I have a book loss of $1 million this year. Well, how much of that am I actually going to be able to take? And then you have to run through the calculations of stock and debt basis limitations, at-risk limitations, passive activity loss limitations, and then finally, while slightly delayed for a couple of years due to the TCJA, excess business loss limitations. One thing to note about the excess business loss limitations is that the limits for 2023 are $578,000 for married filing joint and $289,000 for all filers. So what that means is that if you have a business loss on your return of, let's say, $1 million, and you don't have other business income, you would be limited to $578,000 for a married filing joint return, and the remainder of that would be carried over as a limitation until you have business income to release that. So that's one thing to consider when you're getting down to this last one. Again, that excess business loss limitation is one that came back in 2022 and is one that needs to be considered moving forward. Now, when you get through all of this, when you're planning and reviewing all of this, the things to consider are loans or capital contributions to boost your owner basis. You may be able to increase your stock or debt basis from that perspective to allow more losses to be taken. Additionally, when looking at everything, making sure that you're deferring deductions or accelerating income, depending on if you are in a loss position and you know that you're going to have income in the future. So again, back to the example, let's say you have a current loss of $1 million, but you can accelerate income from that perspective. Will you be able to offset that from that? All right. And Sarah is going to continue on with compensation and benefits.
Great. Before we leave that, we did have a question come in about Section 1231 gains and whether those qualify to be rolled into an opportunity zone fund. And the answer to that is yes, you can roll those. And it doesn't have to be a real estate gain. It can be off of any business asset or any investment type asset. If you have a 1231, if you have a gain, a capital gain or a 1231 gain that can be rolled into an opportunity zone fund and defer the tax. Okay, I reached out to our compensation and benefits planning folks team and said, what can we do between now and the end of the year to really help? And they said, well, there's been a lot of focus on retaining employees and recruiting employees. And here are 2 hot areas that we're seeing talked about a lot to help with retaining employees or recruiting employees with non-taxable compensation to those employees. Yes, it costs the employer and the employer gets a deduction, but the employee does not have to pick this up as income. Student loan debt repayment programs. This is similar and tied into something similar to the tuition reimbursement programs. And so an employer can reimburse up to $5,250 to an employee that has made payments on a qualified student loan debt. And this is an annual amount that can be funded. It is not a salary reduction plan, so it's not like a cafeteria plan. You're not giving up salary in exchange for this. This is in addition to salary. It does require a written plan in place. It must not be discriminatory between high income earners. And this maximum pay amount is combined with other educational assistance exclusion. So you can't, an employee would not be able to take advantage of this and the tuition reimbursement program for more than the same amount. So some combination of the two hits this cap of the $5,250. Similar for parents or others who are caring for dependents. It could be family members who are children, or it could be older adults that are dependents of an employee. There are assistance programs that can be put in place to allow up to $5,000 to be provided tax-free for dependent care expenses. Now, this can be part of a cafeteria plan, a salary reduction plan. And again, it's not discriminatory towards high income earners. Another area that employers can use to save taxes, the Secure 2.0 Act came through and enhanced the benefits towards employers who are setting up retirement plans for the first time. So if we have a small company, less than 100 employees, even better if you have less than 50 employees, there is a credit for the costs of establishing the plan. And there is also a credit for the amount of funds that the company pays in on behalf of that employee to the plan. So an employer can make $1,000 contribution to a profit sharing plan for the benefit of an employee and be reimbursed that same $1,000 in a tax credit. So really beneficial, and that will phase down over the next couple of years how much that credit is, but absolutely super important and a super way to encourage retirement savings and help employers to fund that by these credits that are reimbursed to them. It is treated for a plan that is established, and you can establish a 2023 qualified retirement plan all the way out until September, October, when the tax return is finally due on an extended due date, and can be funded all the way out till then, as long as the funding is for the 2023 activity and compensation of employees. That could still be a deduction on the 2023 tax return. So you can think about this now, execute all the way out in the next 6-8 months, and still get a deduction on your 2023 taxes. One last area is for particularly professional services firms, engineers, architects, doctors, lawyers, other accountants, other consulting firms. We find an opportunity to combine a 401k plan, a profit sharing plan, and a defined benefit plan. Those traditional kinds of pension plans. Together, you can combine those, which really powers up the amount of deduction for your older, more highly compensated employees. They have owners, and they have an opportunity to have a really powerful way to set aside funds now, which doesn't cost that much extra for the employee, the line rank and file employees. So a great way to think about that. If you'd like to supercharge a retirement savings plan, this is a great way to do that. Last savings idea our benefits plans folks had is there is an opportunity. If you can keep your plan participants under 100, then you can escape the cost of having to incur an audit of that plan. And one way to do this is to go ahead and pay out roll over, get former employees with small balance plans, balance accounts out of the plan. So as long as those accounts stay active in the plan, those participants, those former employees still count towards the 100 participants. If you can go ahead and pay them out and roll that money over into an IRA or make some other distribution and close those small accounts, then you can get your employee count down under 100. Also important to note that this $5,000 threshold for paying out small account balances increases to $7,000 in 2024. So hopefully that will help companies with former employees clear out even more of those and stay under that 100 threshold and save overall costs to the plan. Which now brings us to our third polling question. If you want to bring that up, Heather, what is the limit for expensing business meals in 2023? How much of a deduction can you get for a business meal in 2023? Is it 100% deduction, a 50% deduction, or a flat $60 per day? Is there how much can we get for a deduction on the business meals in 2023? We'll give you just a little bit longer to answer this question. We want to make sure everybody gets the CPE credits they need for this year. If you're needing CPE credits. That's great. Right. So Rodney, you know the answer to this question. Tell us how much of a business deduction we're going to get for a business meal in 2023.
50%.
50%, yes, it's going back down. It was 100% for restaurant meals in 2022, but that has dropped us back to just 50% here for business meals in 2023. All right, scrubbing the balance sheet. What's that all about, Rodney?
Thanks, Sarah. So when we're looking at scrubbing the balance sheet, we're trying to find areas in the balance sheet which can be, for the term scrubbed, to generate additional deductions before the year is over. So the first place we go looking for potential deductions when we're scrubbing the balance sheet is tangible property. So how do we take a deduction for the amount that we paid for property sooner? The first item we can look at is the de minimis expensing election. So for taxpayers with applicable financial statements, the de minimis expensing election is $5,000. For taxpayers without applicable financial statements, which, to clarify, an applicable financial statement is a financial statement required to be filed with the SEC or other types of certified audited financial statements accompanied by a CPA report. The taxpayers without an AFS would be $2,500 limit. Again, these limits are per invoice or per item when you're looking at your balance sheet to make sure that they qualify for this de minimis expensing election. So how do we claim the de minimis expensing election? One, you have to have an accounting policy or procedure in place before the tax year begins. So for the 2024 tax period, the policy or procedure should be in place before the end of the year. So by 12/31/23. If you have applicable financial statements, this policy must be in writing. That is an additional requirement placed on those with applicable financial statements. 2, the deduction has to be taken for book purposes. It needs to be included in the deduction that's being taken in the financials. And then lastly, the CPA will prepare an election that's included in the return, and they will ensure that it is also being expensed in the tax return. Now, one thing to note is that this was less of a concern in the past when we had 100% bonus depreciation available. As such, we would be able to take 100% bonus depreciation on any items that we're placing onto the balance sheet. However, now that it's limited to 80%, this is an area to be reviewed so that you can ensure that you're taking the maximum deduction possible. Some other items to be considered for faster cost recovery, looking at catching up missed depreciation or reviewing dates assets placed in service and ensuring that they were placed in service correctly. We previously mentioned cost segregation studies, also looking at identifying deductible repairs if you capitalize those, or claiming partial dispositions. In the claiming partial dispositions, did you significantly repair your roof or replace your roof? Did you replace one of your two elevators, or did you replace 60% of the windows in a building? You can review and determine if you can actually write those items off in the current period while capitalizing your replacement from that perspective. And then also looking at deducting non-incidental materials and supplies. Looking into inventory reserves and subnormal goods. So one thing for retailers to consider is reviewing their inventory reserve accounts and then consider disposing of worthless inventory before year end. Also, for retail consideration, looking at an accelerated deduction for subnormal goods. So to be able to take a deduction for subnormal goods, you have to identify the subnormal inventory. Now, in this scenario, the subnormal inventory has to be something with a defect, or it's open. There has to be an identifiable and specific reasons why it is subnormal. It can't just be that the color is red and it should be black from that perspective. You have to document the reason why it's not saleable at its regular price. So again, you're taking inventory, identifying it, and saying, okay, it's not able to be sold at $5 anymore. I have to sell it for $3. And then you offer it for sale less than cost within 30 days of year end. So note that needs to be either December 2nd to December 31st or January 1st to January 30th. And then once you've done that, you can document and claim the deduction for the unsold items from that perspective. Lastly, when you're looking at inventory, you should also be checking to make sure whether or not you're capitalizing anything with relation to idle equipment or other non-production costs.
Right. And on those subnormal goods, this is an opportunity to take a deduction without actually having to dispose of that inventory and get rid of it. So sometimes there's not time to get rid of that inventory around year end, or you're already in January and you did not dispose of it before December 31. So this is a way to go ahead and get a deduction before you actually dispose of that inventory.
Mm-hmm. Looking at other reserves and accrued expenses, bad debt reserves or asset value reserves. Are those actually collectible at this point? Can they be written off? Are they not realizable? If they are not realizable and they are uncollectible, you can write it off and claim a deduction for it. Other reserves and accrued liabilities, accelerating the payments before the year end to make sure they're deductible in the current period, especially if any of those payments are subject to estimates or anything like that. For bonus plan and compensation accruals, making sure you accelerate payments for greater than 50% owners or all S corporation shareholders so that you can deduct that compensation. And then lastly, looking at deferred compensation plan accruals, as Sarah previously mentioned in a part of her section, looking at the timing of the payments, the vesting, and then also the FICA and Medicare tax deposits. Before we get into just kind of some more high level items, looking at small business exemptions. So there are exemptions available to taxpayers who meet the threshold, who meet the small taxpayer gross receipts test, which is having an average annual gross receipts for the past 3 taxable years of not more than $29 million for 2023, and then also not being a tax shelter. If you meet these exemptions, then you're allowed to take simplified methods as it relates to items such as the Section 163J business interest limitation. That can be that recently switched from being based on a calculation of EBITDA to EBIT. As such, 163J is now hitting taxpayers harder than it was before. Additionally, you can exempt yourself from having to capitalize certain costs under Section 263A uniform capitalization. That is a heavily involved calculation, I will say, that requires additional information from the taxpayer. So it's very nice when you don't have to prepare that calculation. Looking at Section 471 accounting for inventory, if you don't have to account for inventory, you are able to expense for items such as incidental materials and supplies, which is very beneficial to some businesses. Again, there's a list of requirements and other requirements to be able to qualify for that. But if you're under the $29 million, you can at least investigate it. And lastly, for mostly people in the real estate sector looking at the Section 460 long-term contracts, you can look at not having to be on the percentage of completion method, contract method, and defer income. So as I mentioned, getting into some of the more high-level steps, to lower taxes for the end of the year. As we've been talking about this so far, accelerating acquisition of fixed assets into 2023, accelerating charitable contributions, adopting a defined benefit plan, selling depressed value, non-core assets and harvesting losses on that. Adopting a 12-month rule for prepaid expenses and intangible assets. That one is one that can always be looked at from most businesses. What that does is it allows you to accelerate your prepaid expenses to be able to deduct them in the year that you pay them. Again, there's rules in order to meet that. So just one thing to be considered. Looking at abandoning investments or assets, decelerating revenues, slowing your invoicing down and collections at year end, electing an installment sale method, delaying revenue generation, delaying cancellation of debt transactions, or claiming R&D tax credits or WOTC. On the R&D tax credits, one item to note there is that you would prepare a study for that, and we do have tax credits incentive teams who have webinars on that as well to provide more information on that. Lastly, as we kind of mentioned earlier, if you have losses that you're expecting through the business year and you want to accelerate income to put it into this period so you don't have to, so that you can use the losses you've generated to offset that income, there are ways to increase your income and taxes from that perspective. Some of the main methods are changing to accrual method from cash, electing out of bonus depreciation. On that one, electing out of bonus depreciation is a specific election on the return, and it is by asset class. Changing to the full inclusion for advance payments. Generally, deferred revenue is allowed to be, for tax, you're allowed to defer deferred revenue for one tax period. However, if you want to shift to the full inclusion method, you can do that. Changing from lower cost of market to cost for inventory, changing from LIFO to FIFO are a number of methods in order to take advantage of either passive previous losses or current losses in the period, depending on whether or not they were limited previously. Some other actions are accelerating loan modifications or collecting SALT or non-owner grants. Considering a change of tax entity. On that one, there's always implications to changing your tax entity, so it is something to heavily review with your tax advisor. Accelerating cancellation of debt transaction or accelerating revenues. And now Sarah's going to be talking about some other taxes and transaction items as it relates to international.
Right, so we don't want to forget that federal taxes are not the only taxes that income type taxes that companies pay, and there's lots of taxes that companies pay. But from an international standpoint, optimizing your structure for U.S. tax laws, the Pillar 1, Pillar 2, OECD, BEAT, other tax provisions that are out there, GILTI and FDII, want to make sure that companies are operating in the best structure they can under U.S. tax laws and foreign tax laws. It is a great time to update your entity organization chart. Where are your business entities? Who owns them? And in what countries do they operate? Or even what states do they operate in? Updating transfer pricing documentation, and particularly making sure if you have transfer pricing documents, that the documentation and documents that transfer pricing is actually taking place. In a year of last 2 years of high inflation, high interest rates, it's a great time to go back and look at those transfer pricing documents and arrangements and see that they're being implemented properly and thoroughly. If you get them into your books and records now, then you don't have to deal with updating them or making post-year-end adjustments for transfer pricing after the fact. It's a lot easier to get it into your books and records now than it is after you're in. And finally, we want to make sure, particularly when we bring on new clients, that all their prior year reporting for forms 54, 71, 72, the bank account reportings, all those international reportings, the penalties are so steep and so high, and they just don't go away. So we want to make sure that all of those forms are filed and caught up for prior years, and that we're set and ready to go for the current year. And you know what to expect. I mean, they've gotten more complicated and more intensive over the last number of years, and the IRS is asking for more and more information and data all the time. Along those same lines, we want to think about our state and local tax planning, our SALT concerns. Number one, we have to look at, is the state complying with or coupling or decoupling from the Internal Revenue Code? How much do they follow? Many of the states decoupled from Section 163J interest expense limitations. They decoupled from bonus. Now we've got a new threshold to look at it because some of the 20% of the cost is not subject to bonus depreciation. And so that will be the same, maybe the same for state purposes. The other will have to be adjusted. Section 174 is another area that states may be complying with, may have decoupled from, and there are plenty of other code sections as well to take a look at. Nexus and apportionment. Where is the company sourcing its revenue? How is it sourcing its revenue? Are there remote workers? Now that employees are working from anywhere and everywhere, are your employees all staying within the U.S. borders? Are they operating overseas? Are they moving from state to state? How are we tracking where you have employees now? Also, if you're selling a business, those gains from the business, you may think, well, I sold it from this state where I'm resident and I own the stock or I own the partnership interest, but the business gains may be allocable to multiple states where the states actually had operations. So very important that we think about that with year-end planning to make sure that we're making extension payments and that we're making estimated payments in all of the state locations that we need to. And as Rodney mentioned at the very top, we cannot forget the pass-through entity tax elections and the pass-through entity tax. That's super important, super complicated, and we need to be in front of that as quickly as we can. We do have an internal team that helps companies to find grants, to take advantage of credits and other incentives when they are spending new capital or expanding workforce or even retraining workforce or retooling equipment, relocating operations, or particularly when we see inbound operations or even expanding operations. There are lots of incentives and credits available, and some of those can create taxable income to a company when those funds or benefits are received, and some will be benefits when those tax payments are not needed because you have credits or other incentives to reduce those. And Rodney, you see a lot of transactions going on with the businesses that you deal with and the taxpayers. Talk a little bit about what to look for with M&A transactions.
Yeah, M&A is always an interesting area because there's always a number of considerations to go on, and sometimes I find that people's last question is well, how does that impact taxes? And there's a wide variety of considerations, such as, is it a stock deal or an asset deal? Those are probably that's the initial question. After that, if it's a stock deal, or depending on the entity structure, are we able to get any sort of tax-free treatment out of this, for a contribution or anything like that? Am I selling a corporation? Am I selling an S corporation? Am I selling a partnership interest? Am I selling a disregarded entity for tax purposes, which just means that it's an entity that that federally is not recognized, but owned 100% by any of the previous items I just listed. So when you're looking at it, the first item being is that, am I the buyer or the seller? From there, looking at what are the impacts to me as the buyer? Am I getting step up in an asset sale? Does that mean I can take accelerated depreciation on any of these items? For fixed assets that I've acquired, or is it all going to be allocated to goodwill, or is it going to be allocated to an intangible? Additionally, looking at the due diligence considerations, there's a number of items to be provided prior to your tax returns. As Sarah just talked about, SALT planning concerns, looking at your revenue sourcing from that perspective, that's a big item. Additionally, sales and use taxes. I have seen more than one deal be blown up by the fact of sales and use taxes not being properly accounted for. So reviewing that and those informations from the industry side and client side, looking at what tax issues are out there, if there's anything that we haven't, anything that hasn't been considered previously, or something that had been considered de minimis, but now should be considered in relation to the due diligence and file and the deal. Additionally, looking at your tax accounting methods. Does the company take certain positions as it relates to how they do their deferred revenue? Are we on the full inclusion method? How does that impact the buyer if I'm selling? Does the buyer have to make any accounting changes? And would that impact the sales price of my deal? And then lastly, second to last, looking at the multiple sources of capital, as I said at the beginning, identifying, is there any portion of this that could be tax-free? Am I selling my business and receiving something in return? Am I able to defer the gain on that in a rollover transaction? There's a number of different strategies available, and in order to restructure your business to qualify for these situations where you can get a rollover equity, and you can do them as you're planning and doing the deal from that perspective. And then lastly, as I've kind of said multiple times here, gain deferral, looking at installment sales, deferrals of that method, or deferral via rollover and ownership in the new entity. There's a number of items to be considered, as I've talked briefly here for the last probably 30 seconds, but it is a laundry list of items that are essential to talk about with your tax advisor when you're looking at either buying or selling a business.
Right. Yep,
go ahead.
I think we're up to our next polling question. Just to get a sense for where you are coming from. Are you expecting your business income to increase, decrease, or stay about the same in 2024? I'd love to know how you're feeling about 2024 compared to 2023. Hopefully it's all increasing. We're all looking for a better 2024, unless you had a great 2023. In which case I hope it's going to be at least that good for you again next year. So how are you feeling about where 2024 falls out? And then Rodney, I think we just have a minute or two to wrap up on our last slide there. We've got one more slide to go with some final reminders. And I'll go ahead and let you start talking about that while people are still finishing up the poll.
Understood. So from the perspective, as we just talked about with the polling question, does the company project higher profits and taxes in 2024 than 2023? So from that perspective, should you be deferring any deductions into 2024 from that perspective, if you can, or should you be accelerating any income into 23 if you have any losses, as we talked about? How much estimated tax have you already paid in 2023? Something that a lot of people aren't considering or just didn't realize before was that the underpayment rates from the IRS's perspective and even the states were much lower than before. Those interest rates are now pushing 6, 7, 8% on the basis from that perspective. So whereas maybe from 2018 to 2021, if we didn't pay if the taxpayer wasn't paying in their estimated taxes because they thought they could get a better return investing in the business, that just may be a bigger bite, I'll call it, when you get to the end of the year. Planning for extensions and preparing filing of returns. Are you planning to extend? If so, will the information be available in order to file your extensions timely? Then lastly, looking at the sunset of TCJA tax reductions for individuals after 2025. A lot of items are sunsetting where the individual tax benefits are going away from, the tax rate reduction, the lifetime exclusion, 199A. Closely held businesses need to review these things and identifying how does that impact me? What planning should I be doing now? For those of you planning on making any gifts or have large values in businesses from that perspective, speaking with your advisors right now in order to take advantage of that lifetime exclusion will be very important. So at the end of the day, what planning can we help you with? We have a wide breadth of private client service, corporate tax credits and incentives, compensation and benefits from the entire team here that are available to assist you with whatever you need.
Great. Thank you, Rodney. Thank you all. We appreciate your time today. And if you have any follow-up questions, you can reach out to us or reach out to Cherry Bekaert, and we look forward to having you. So thank you very much for your attendance today. There is a short survey which will come up, and we would appreciate your feedback on this presentation and on other presentations you'd like to hear from us about. So thank you.